Forecasting interest rates this month seems like March Madness. It is a complete head fake. You have interest rates that go up towards 7% by the end of 2022, and then they come and they reverse themselves. And then in February, for 2 weeks, they have another increase. All the while, last week, the Feds increased interest rates by a minor quarter percentage points. And although the Feds don't have a direct correlation with what happens to the 30-year mortgage rate, they definitely have an impact. It's more of the 10-year Treasury yield, because what banks like to see is a spread between 1.5% and 2% between the yield and the interest rate. So in January of 2022, when interest rates were 3.75, the 10-year Treasury yield was about 1.5 percentage points under that, at about 1.82%, which is a really healthy spread between the two, usually between 1.5 and 2 percentage points. However, by November, when interest rates were at 6.75%, the yield was at 4%, almost 300 basis points, almost 3%. So that uncertainty is coming from different things. It's coming from the high inflation that we're seeing and receiving, and then also just the government having a hard time getting inflation in check. So oftentimes the government prints money to bring back down inflation. And right now you see that we had some banks that went belly up, let's say, and so the government is quietly printing money. So with the government printing money, interest rates will still push back down. So NAR, the National Association of Realtors, predicts that interest rates will continue to fall into the 6% range, and by the end of the year in the 5.8% range. However, Fannie Mae, if you remember that I've been talking about this, an article in November says that interest rates will go into the 4s by the end of the year. So whatever happens, you've got to admit there's a lot of head fakes going on and a lot of March Madness, as you cannot really predict what interest rates are, what's happening with interest rates. A lot of it's due to inflation. Inflation, if you remember, last year hit as high as 9.1%. It's currently in the 6s. One of the hardest issues is the central banks trying to control inflation. We're not a manufacturing industry anymore, so it's a lot more difficult to control supply chains. You really can't when we're more of a service industry. So keeping that inflation in check has been really, really difficult. During the pandemic, it spurred trillions and trillions of dollars of spending, and in order to spur the economy, and also disrupted our supply chain. So there's a lot of issues going on here, and it's really hard to predict where interest rates are going. But I have to tell you that as you have different things that happen with banks going under and the government working to bail them out, that means that we have to print money in order for that to happen. And whenever you have quantitative easing, the printing of money, you usually have interest rates suppressing. It would be really nice as well if we could get that 10-year yield curve and interest rates to be in more of a normalcy of a spread of 1.5 to 2 percentage points. That would really mean that most likely interest rates will come down into the 5s minimally, as we continue into 2023 and get closer and closer to 2024 elections. This is Dawn Connors at Mortgage One. Thank you so much for watching my mortgage update and kind of what's happening in the news with interest rates. Welcome to the spring selling market. I hope it's a great one for you.